It's extremely hard to raise money. Okay. So anybody who's trying to get into it, like, do not believe these podcasts that tell you, oh, if you have a deal, the money will just flow in. It's not true. It's really not true. And even if it's friends and family, like friends and family don't want to lose their money, right? And
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome everybody to today's capital raising show. Today I have my special guest, someone who I've met recently, heard him spoke on stage a couple weeks ago, and I was so inspired by his story, how he got started. I came up and told him, it's like, dude, I want to interview you, and I want a copy of your slides so I can print them out on my vision board. And that's how excited I was to meet Zach Haptonstall. Zach is the CEO and co-founder of Rice 48 Equity. They started in 2019 and went from basically in the last 3 years went from zero as a new business to now over $1.5 billion in transactions. And they have over 100 full-time employees in Phoenix area. Zach's background includes healthcare, sales and administration. Used to be a former president and co-owner of Hospice Organization in Phoenix with over 110 employees, over $9 million annual revenue. So that'll be interesting to hear how he tapped into that network of physicians, right, to raise his money. He also used to be a former live television news anchor and sports reporter in Arizona. And Zach holds an MBA in Colangelo College of Business, Grand Canyon University. And Zach is a licensed real estate agent since 2016, member of the Forbes Real Estate Council, Directors Council member of GPEC, best-selling co-author of The Success Habits of Super Achievers. Welcome, Zach.
yeah, no, thanks so much, Tim. Really appreciate it, man. Great meeting you in Charlotte a few weeks ago at the conference, and appreciate you giving us the opportunity to be on the show here and the event. Thanks everybody for taking the time. Good to meet everybody here.
Yeah, definitely. We're excited to meet you. And I've been pumping everyone up about your origin story. I would love to, let's just start out. If you can share with us how you got started in commercial real estate. What got you even get started in commercial real estate, decide to get into commercial real estate?
Yeah, absolutely. So a little bit about myself. So yeah, I was born and raised here in Phoenix. So lived here my entire life. And I just come from a lower middle class family, no real estate background, no rich uncle or anything like that with any real estate connections. I had a journalism degree. So I was a live news anchor for Arizona PBS and a sports reporter, hosted a show on Fox Sports Network for a short time, which was cool at first. And then, I quickly realized you can't make any money doing that in journalism. And I had a bunch of school that I needed to pay off. So I was like, I don't want to do this. And so, while I was going to school, I was delivering medical equipment like nights and weekends full time, just like an odd job I got through a girlfriend at the time to pay for school. And so after, I decided I don't want to do journalism, I kind of parlayed that into healthcare marketing, working for a hospice organization. So, I became a marketer, director of marketing, and then later, president and co-owner of a large hospice organization. And, it sounds kind of weird, but, hospice is actually a very competitive and lucrative private business industry. And Phoenix is one of the top markets in the country. And so, I was very fortunate, at a young age to start making like six figures, in essentially this sales role. And so by the time I was 23, I was making like 150K a year, making, more money than both my parents combined. Bought my first house when I was 23. And then, got my MBA, paid for it with cash. So I was just, kind of following the Dave Ramsey plan, which I think a lot of us are taught, right? You're taught to go to school, get a degree, save your money. And that's what I was doing. So I had, this strong 6-figure income. I didn't have kids or anything like that, paid off all my school debt, bought a house. And I had, established a good, financial foundation, but I wasn't happy and I wasn't fulfilled, and it's always like, what have you done for me lately in a role like that, getting taxed heavily. And so, I did that for about 4 years or so. I was making over 200K a year and just felt, very unsatisfied. And so January 2018, I resigned and I became a co-owner of that company. I sold my equity in that company And I had no idea what I wanted to do. I just knew I wanted to make money somehow, passive income through real estate. And I had gotten my real estate license a couple years prior, but never used it. Okay. It was just kind of a backup plan. So I knew nothing about investing, knew nothing about real estate, but I had no time to figure out what I wanted to do because I was, just constantly working on call 7 days a week with this job. So, I quit the job and I initially was looking at flipping homes. And then I realized, this is transactional. This is what I basically just left. I don't want to do that. Then I learned about mobile home parks and kind of, the beauty of cash flow, passive income. And I had about 300K of cash that I had like relentlessly saved, got a little bit of a pop from selling that equity in that company. And so I was trying to buy a mobile home park myself, like a small one on a seller carry. Okay. Cause I knew I probably couldn't qualify for financing. So I cold called around 90 different mobile home park owners trying to buy these, deals. Most people didn't even answer me. I had a handful of people who would actually answer or call me back and they weren't interested. So, long story short, months go by, I'm trying to figure this out. I learned about multifamily and syndication through a podcast. Okay. And so that's when I decided, this is what I need to do. And syndication, the light bulb kind of went off for me because, being in healthcare, I was marketing directly to and had a lot of relationships with like physicians, healthcare business owners, people who have strong income and want to put that money to work, but don't have any time to do that. And so I was like, this could be my thing where I can really leverage my time and energy to help other people. And then I can go a lot further because, as I was looking at those mobile home parks, I started realizing, okay, well, what if I put this 300K and I go buy a mobile home park, a $1.5 million park, whatever it is. Well, then I'm out of cash, right? And then maybe I make $2 or $3 grand in a month in cash flow. That's not really true financial freedom. That's not real wealth, And then what do I do? And so when I learned about syndication and the GP promote or the sweat equity, that was like, that really kind of triggered something in me where I was like, that's a business you could scale. Because I was going through this for several months. And long story short, it was 14 months from when I quit that job to buying the first deal. And there was a lot of adversity that I went through personally because I went from getting, fat paychecks every 2 weeks and in all humility, truly being elite in my industry and waking up in the morning and knowing what I have to do and go, dominate the competition, so to speak, to now waking up in the morning and I don't know what I'm supposed to do today. I don't know how do I move the needle. I'm burning through cash. There's nobody there to hold you accountable. There's nobody there to tell you what to do. But I started just cold calling brokers, lenders, property managers, setting up meetings, started going to conferences, and traveling to different conferences. And so long story short, 10 months into that, so October of 2018, I met one of my business partners, Robert, who was here locally. I met him at a conference. We put an offer on a deal. It was 36 units, 3.5 million. The offer got accepted and we're like, oh crap, what do we do now? We didn't expect that to actually happen. I go non-refundable for 25K, Robert's non-refundable for 25K. And the plan was to syndicate that deal. Okay. It was about 3.5 million, 36 units. We had to raise about 1.4 million of equity. And we go to all these people we've been talking to in the last several months to raise money and none of them are interested. They all go silent. Okay. And that's a scary feeling. And it's because we didn't have a track record, right? We didn't have any credibility. And so really had to bootstrap that deal and get it closed. I mean, it was a long, stressful 4-month escrow. I had about 165K left because I was burning through cash, going to conferences, joining mentorship programs, et cetera. I put 160 of that 165 into the deal. So I was pretty much all in. And my whole thing was I need to show other people that I believe in the deal. And I would literally go with show up to meetings with a bank statement and show them, this is my cash. I'm all in. Are you willing to invest? Are you interested? Robert put about 275 in. By the grace of God, I found a 1031 exchange. Somebody was selling a 12 unit in Seattle, brought in about 650. And then I met our third partner, Bikron, during escrow. I met him and he put in 150. I talked him into it. And we got a couple other people and we just bootstrapped that thing. We actually did a tenant in common or a tick structure, closed that first deal. Okay. So long story short, it was 14 months from quitting the job. This was all I was focused on to actually getting that first deal done. And I was basically broke at that point. I had no cash, I was in credit card debt. And so I sold my house because I had no more cash. Wow. I knew I needed earnest money from their house. So I sold the house and I knew when we were in escrow for the first one, we wanted to keep scaling. So I actually listed it for sale while we were in escrow it closed shortly after that. I had about 120K come from the sale of my house, tax-free, because I owned it for a few years. And literally the next week after it closed, I wired 100K non-refundable day one into a portfolio of like a 59 unit and a 76 unit. And we did another tick on the 59 unit. We syndicated the 76 unit. And long story short, we kind of gained a lot of momentum, through that process. And so, we closed that first deal in February of 19. Since then, we've acquired 34 different properties, all here in the Phoenix metro, worth over 1.2 billion, over 5,700 units. Every deal we've syndicated with retail investors. I guess we've done a couple ticks, but we've never done like a JV with private equity. So we have 100% autonomy, 100% control. We've got a business office here in the Phoenix area. We've started our own property management company, Rise 48 Communities. So we're completely vertically integrated. And as of today, we have 139 full-time employees on full benefits. And so, we've been very fortunate to kind of build this momentum and build out the infrastructure to where now it's really just rinse and repeat the same business plan over and over, right? And we're just kind of cranking this same structure, looking for the same deals. And we've intentionally stayed focused on this market, this strategy, because we've eliminated a lot of variables and a lot of risk. And so that's kind of what we've been doing, is just focus solely on Phoenix value add multifamily. And that's kind of what's happened in the last 4 or 5 years or so for us.
Yeah, that's super, super impressive. Do you mind me asking how old you are?
Yeah, no problem. Yeah, so I'm 30. When we bought
cow.
the first deal, I think I was like 26, about to turn 27. And yeah, I mean, that's one thing I tell people too, is like, no matter how young or old you are, it really doesn't need to be an obstacle. I mean, my biggest thing is I was so nervous and like terrified of meeting with these brokers, because it's intimidating, right? Like you feel like I felt insecure and have like anxiety, because these are big numbers, big buildings. You feel like you don't belong, but you have to just kind of push through the fear, right? And the more you do it, you start to get more confidence, and you can't be afraid to fail. So that's been our thing. And I tell people too, is like, once you start getting results, the results will speak for themselves, and even raising capital initially is tougher, when you're younger, but when you start to demonstrate, professionalism and results, then the rest can kind of fall into place.
Yeah, I love it. And what would you say is how much you've raised so far since that first deal?
Yeah, good question. So we've raised about $450 million of equity from retail investors since we've started. We've bought about 1.2 billion. We've really, just started to see exponential growth, exponential demand. Because like I said, it took 14 months to buy the first deal. I think we bought 4 deals, like 35 million in 2019. We felt like we were really starting to hit our stride, and then COVID hits, right? We bought a deal in March, which was frustrating because we started getting off-market deals. We started getting a lot of momentum, and then we felt like we were just stuck because of COVID. The first 3 to 4 months we paused, and then we started realizing, what? The portfolio is performing extremely well. And so we started going after deals third and fourth quarter in COVID, sourcing, 4 or 5 deals off market. And we've already sold all those now. They were all home runs. And so, what's a big part of our success in being able to scale with raising capital has been going full cycle on these deals. Okay. So we've now successfully executed the plan, gone full cycle, and sold 10 different assets. Okay. 10 different sets of investors. We're selling our 11th deal this Friday, the 15th. And we've drastically exceeded our return projections, in a short amount of time. And so we like to utilize the 1031 exchange. We'll have 1031 exchange 7 of those 11 into new deals. We typically have a 90 to 95% conversion ratio of investors who want to participate in the exchange, and they do have the option. And as we're selling deals and going full cycle, we're just getting flooded with referrals of investors who are referring their colleagues, their friends, their family. My wife, Grace, does all of our online marketing, SEO, and she's very prolific with that. And so, we get a lot of leads from LinkedIn, and Grace basically runs my LinkedIn. So I do go on there and look at stuff and like stuff, but she does all the content for like the last 2 years, her and her team. She's got three staff members that work with her. But so yeah, I mean, we've been able to really attract a lot of people compliantly, with SEC guidelines. So we're putting out content, and everything that we're doing online with these posts is to drive people to a calendar link to set up a call with me. Okay. So, no exaggeration, I'm having anywhere between 3 to 7 phone calls a day with new investors who are qualified leads, who understand how this stuff works for the most part. They've been referred to us. They found us through a search engine. They saw us on LinkedIn. And we're just kind of cranking these phone calls to establish these SEC compliant pre-existing relationships. And then, we're raising a lot of money from retail passive investors. And so that's kind of how we've really started to scale.
I love it. And I know you guys have grown a lot in the last 3 years, over $1 billion, right? Over 1.5 billion asset under management. Did you guys start out with that goal in mind? Or, I guess after your first deal, did you like, okay, let's go for the billion?
Yeah, good question, Tim. So, we didn't necessarily start with that concrete number, but we were very ambitious from the very beginning. Okay. So even before we had because basically, for me personally, just to be transparent, like I did go through like a lot of adversity. Like when I was in that first year, I had a ton of people telling me like, you can't do this. What are you doing? Like even my own parents, like you just left 200K to go do this. And it's embarrassing. Honestly, it was tough. And you get to the point where it really, builds your character and you almost get a chip on your shoulder where you're like, you know what? Now we're going to go crazy. And when we get this thing, we're going to really scale it big time. And so even after we got the first deal, the goal was to buy 1,000 units in year one, which seemed very ambitious. And we didn't even get close to that in year one. It was too much, but we were thinking of scaling quickly. And that's why I sold the house even before we closed the first deal, because, we believed we could do it. And so, our goal last year in 2021, which we had set in the fall of 2020, was to buy $250 million worth of real estate in 2021. And as we started going and riding that momentum with, getting more deal flow from brokers, most of our deals are sourced completely off market through broker relationships. So I handle all the broker relationships. And have really, we've been able to gain a big advantage there. But we started getting a lot of off market deal flow. We started getting more demand with our equity. And so we ended up buying 560 million last year. So we doubled that goal. And that kind of showed us what we can do, right? Because when you start to get the rhythm of this thing, you're like, you know what? You start to see from a high level a blueprint and a process that can be repeated over and over. And every transaction is stressful, right? You never know when you send that email out, are these investors going to commit? It's always scary, right? Like even we launched a deal a few weeks ago, and I was telling people, like I was telling our partners, I was like, this might be the deal we lose our earnest money because there's so much interest rate, fear out there. We didn't know if investors were going to pause. We had crazy demand and kind of blew the roof off it. And so, you just never know, but you have to constantly be pushing your comfort zone in order to scale, because you're doing things that you've never done, and they're scary things. But yeah, so we bought, 560 last year. Our goal coming into this year was to buy $1 billion of real estate in 2022. And, we, so far from January through June, we've purchased 630 million this year, about 2,300 units. So it's been crazy. At one point we had 10 deals over 600 million under contract. Wow. And that's stressful even if you think about it, because we know we have to launch a deal every 3 weeks. We don't ever launch a deal at the same time. So it's like, we're looking at this string and I'm like, man, at which point are we going to, break the camel's back, so to speak? But we closed 9 of those 10 now. It's kind of crazy. Impressive. And so you kind of focus on what's in front of you and execute, each step and stay laser focused. And, the path will kind of show its way. And so, now, because of interest rates, because of the debt environment, things have really slowed down. We've had at all times at least 2 or more deals under contract to purchase for almost 24 consecutive months. Right now, we have 1 more deal under contract. We're closing in the next couple of weeks, and we have nothing beyond that, nothing in the pipeline. Even in March, we had 9 or 10 deals under contract. We've closed all but 1 of those, and it's 100% driven by the debt, right? It's hard to find deals that make sense, and the seller expectations have not adjusted enough, with our conservative underwriting for that to work. So that's kind of what the goal setting was. And now it shows you what you can do, right? It gives you confidence, and you start to build out infrastructure. And believe it or not, on a day-to-day basis, I'm doing less now than I was even 12, 18 months ago, because, Bikram, Robert, and I, we literally did every little minutia detail for the company you can imagine, from underwriting, handling all the loan docs, raising money, acquisitions, investor relations, construction management. I was out at the property, chewing out vendors for the first property, making sure they're doing what they're supposed to do. And now we've built that infrastructure, because we know the details, we've been able to recruit, hire, and train people to do each role, and then they can start building out staff, beneath them. And so that's allowed us to kind of free up on what is our highest and best use of our time. So that's allowed us to kind of build out real infrastructure here.
That's amazing. Is there an upper cap you're going after? Is it $1 trillion? What is it?
No, yeah, good question. So, I mean, we're trying to stay, super focused on just that $1 billion goal this year. And obviously, whenever we set these goals, we say, within the realm of conservative underwriting, right? We don't want to be known as these crazy guys that are overpaying. And our investors are not dumb, right? They're very sophisticated. And on an intro call, I'm spending at least 30 to 60 minutes with every single investor because I give them a full overview, address all their questions, and investors, they're going to hammer you. It doesn't matter how many deals you sold. I'm constantly getting hammered with questions, and you have to be able to answer all those questions. And so, within the realm of conservative underwriting, and so I think our deal flow will start to slow down here, but we do think that we're still very bullish on the asset class and the market here in Phoenix. We sent 3 offers in the last few days. I'm about to send 2 offers by this evening. I just talked to a broker. And so we're making offers. It's just that, it's harder right now to get the debt to work because it's very volatile. And so, we're just focused on that 1 billion. But, as far as kind of abstract goals, we've talked about different things. We've, probably 95% of our equity we've just done on an individual deal syndication level, right? And that's what we found to be most effective. We've had 2 funds. We started Rise Fund 1 in the fall of 2020. We have Rise Fund 2 right now, and we'll start Rise Fund 3 next year. So we do have funds that we raise, but we've seen a lot more success launching a deal, to investors because investors understand the economics of that deal. Whereas with the fund, it gets more complex, right? So we haven't really marketed our funds, but we really want to make a point to kind of build the fund model out. In addition to the individual deal syndication. And I mean, we don't have concrete goals yet, but we have, potentially abstract goals of maybe going public, in a few years and just seeing what that would look like. But ultimately, we're utilizing the 1031 exchange and we're trying to do whatever's most tax efficient for investors. And so, if somebody invests today, 100K, we want to be able to sell that deal 2 or 3 times, get close to doubling their money, exchange it. And then, 5 to 7 years from now, if the market's overheated, we would sell again and exchange into like a newer Class A luxury apartment building, and then do a cash out refi, hold it long term. So when we talk to investors, they say, well, you guys have been growing so fast. What's your plan? Well, the plan is to continue to execute, in this market and do a good job with operations. And we don't have any plans right now of expanding, just because we have so much infrastructure here. We control our supply chain. We buy everything directly wholesale from the manufacturer. Our manufacturer has plants in Taiwan, Vietnam, and Shanghai. So we're buying all of our flooring, countertops, appliances, cabinets, everything directly wholesale. So we control the supply chain. We do construction management in-house, property management in-house. So, we haven't talked about expanding to another market yet, just because Phoenix is such a large market, with so much inventory to buy. But that kind of, talks about some of our future goals.
That's awesome. So I'm curious as to, I know you mentioned on your very first raise, one of the challenges that you had was not having that track record for investors to feel confident in investing with you. What were the challenges in your second and third deal? And then what are some of the challenges you're dealing with now? I mean, you have an amazing track record now, so I'd love to hear the different challenges and different stages of your growth there.
Yeah, and it's a great question, Tim. And I'd always tell people it's extremely hard to raise money. Okay, so anybody who's trying to get into it, do not believe these podcasts that tell you, oh, if you have a deal, the money will just flow in. It's not true. It's really not true. And even if it's friends and family, friends and family don't want to lose their money, right? And so when you're first starting out, you don't know what you're doing necessarily because you don't have the experience. And so it's a scary thing because you want to believe in it and you have to kind of convince somebody. But you also don't want to lose their money, right? So it's a tough thing. And so, I think in the beginning, I always tell people for the first deal, just do whatever you have to do to close that deal at all costs. Okay. You don't have to syndicate it. It does not have to be a 100-unit deal. I was so fixated when I started on doing a 100+ unit deal because you read the books, listen to the podcast, they tell you you have to have economies of scale. You have to have full-time on-site management. Yes, those things, help. but just get the first deal done. Even if it's a 5-unit deal, a 10-unit deal, if it's you and a few people, or it's your family, whatever, because that will give you a ton of confidence and experience and momentum to then go forward. And it gives you credibility and track record. I can tell you now, we're raising capital, and a lot of these investors are barely even focused on the subject property they're investing in. They're talking about our history, our track record, our infrastructure. Okay. Because, you hear the kind of the cliche that they're betting on the jockey, not the horse, so to speak, with sponsor. It's true. Like, people want to invest in a sponsor that they trust is going to be a good steward of their capital. And so you have to build that track record up with performance. And it doesn't necessarily need to be a big deal. So if you can start smaller, you're going to start that cycle of momentum much faster. And, it might take one guy 18, 24 months and he buys a 100-unit deal, but he has like 10 co-GPs. Well, the guy that bought a 5-unit in like 3 to 6 months might have already scaled and bought much more than the other guy by that point, because you just need to get that first one rolling. And so, in the second and third deal, we bought our second and third deals, not too long after, the first one. So we had, similar struggles, but, at that point we had done a lot more networking by going to conferences, meetup groups, things like that. We at least had a deal under our belt, and we were showing those investors what we were actively doing, so you renovate a few units, you just show them kind of like a case study. You say, look, we bought this deal. We've already completed the exterior paint. It was at X rent when we bought it. We renovated this. Now it's at X rent. We've increased the value this much. And you're trying to kind of educate these people. So it takes time. And, when you're starting out, I think the biggest thing is to identify, what is your true strength as part of the company, and what is your value? Because there's, and what are you passionate about? What do you want to do? Because there's so many different components of this, right? There's like, you have to have the person that can, really work the brokers and constantly stay in front of them and be sourcing deals and raising capital. You have to have somebody who's very savvy with financial analysis. So I met Bikram, Bikram Sandhu, our CFO, is the perfect complement to me. He's got an economics degree, CPA, worked at PricewaterhouseCoopers, auditing Fortune 100 companies. So elite financial analysis skills. I have an MBA, I've taken, high level accounting, but I hate doing that stuff. I hate underwriting deals, it drives me crazy. And I underwrote the first few deals, but I'm not anywhere near his level, of intelligence. And so I had to find a true complementary partner. And I had to, like, quote unquote, date like 7 or 8 different business partners before I met him. Meaning, you meet people at meetups or conferences, you say, hey, I want to do multifamily. You want to do multifamily? Let's start underwriting deals, making offers. And you start to find, okay, some people, they don't work as hard as you. Some people, you can't get a hold of them. Some guys were extremely experienced, had a couple thousand units, but then I realized they're just taking advantage of me. They're not doing any work. You know what I mean? And so you have to find that complementary skill set, which is key. And, once you can do that, you can kind of focus on what you do best and start scaling from there. But yeah, answer your question, it's all about momentum. And so, maybe you need to partner with somebody who has more experience raising capital as a co-GP, and you have to identify what value can I bring to this person. And that might not be your long-term partner. That might be the guy that you work with for the first 1 or 2 deals, and they're signing on the loan to help you with those net worth liquidity requirements. They raise some capital, but you have to be able to demonstrate to them that you bring value, right? Otherwise, why would they want to work with you? So you kind of have to do whatever you got to do, to get it moving.
Gotcha. Well, that's really good. And what are your challenges now when it comes to raising money?
Yeah. So, it depends on the timing. Even in the last, 6, 8 weeks, it's discussing, what conservative measures have we put into our model to mitigate against rising interest rates, right? And so that's the most relevant, where we have to explain to investors, that we're building interest rate expansion into our model, which we always have done. We have an interest rate cap on the loan, and then we have an interest rate sensitivity analysis that we put into our slide deck and webinar presentation that shows investors, different scenarios of what your return looks like with different scenarios of interest rates. And it shows you, in the worst case scenario, if the interest rate goes all the way up to the max, what does your projected return looks like? And so, a lot of investors they're very sophisticated. Okay. Even if they're people investing 50K, they know their stuff, and you have to be able to talk through different scenarios with them and understand what your business plan really is. Because, people are going to ask you, okay, well, you have a 3-year bridge loan with 2 1-year extensions. What are you going to do at the end of year 3? And, we say, well, we're building in a refinance at the end of year 2 into a Freddie Mac 10-year loan. So by the end of year 2, we're either going to sell or refi. but we're not assuming to return significant capital back to investors upon a refi because we don't want to, make our underwriting model heavily reliant on this big refi. And then they say, well, what if you can't refi? Well, then we exercise our extensions. We buy another cap, take us to year 5, and then we refi ourselves. So you have to talk about different scenarios. So, a lot of the challenges right now are surrounding debt and things like that. And, you've got people who there are skittish, right? Because of all the uncertainty in the economy. You also have people who, we were worried that so many people were going to be hesitant. They didn't want to invest in this most recent deal we launched a few weeks ago. We saw as a whole, from a macro perspective, from our database, we saw the opposite effect. We saw people like doubling down and more people coming in, because I think a lot of people who understand real estate, they realize there's not really anywhere else to go right now. It's like people don't believe in the stock market. They don't trust it. Crypto makes no sense. It's not really built on fundamentals. It's very speculative. You talk about, I think even people who aren't sophisticated, they understand the mainstream narrative of inflation and that having cash in the bank, is basically eating up your money. And so I think that now our track record has really benefited us. But I've been talking to other sponsors, I've got a lot of friends across the country, like especially in the Sun Belt, Texas, Florida, who are saying they're having a lot of issues raising capital right now, right? Because people just want to pause. And so I think, a lot of it's based on the macro components. And it can be challenging right now if you don't have a strong track record, because people are wanting to invest with somebody that they feel is doing a conservative job and has track record, especially as you're going into a potentially, economic downturn type of time.
Right. Those are super awesome insights. I know you're very niche. You're niche into the Phoenix market. You're niche into Class B value add properties. Has that been a positive factor when it comes to raising money? Like do your investors like the fact that you're so niche and you're so focused in that?
100%. Absolutely. Yeah. I think that makes we get a lot of feedback from investors. Even most recently, even a couple of investors yesterday I talked to, said that they like the fact that we're laser focused on one market, that we're completely vertically integrated. So we have control over the property management. We have control over all the construction management. And then we have control over our supply chain, right? Because that eliminates a lot of risks and a lot of variables, because we can point, to our portfolio. And like we launched a new deal, for example. Well, we own 3 other deals within a 5-minute radius. Okay. And we can point to those other deals and say, listen, it's the same vintage, same size, same submarket and tenant demographic of deals that are already under our portfolio that are performing very well. Right. And so a lot of people, it removes risk from people, because we're using the same materials, doing the same business plan, kind of just rinse and repeat, stamping the same thing. And so it helps a lot. And some investors say, well, isn't it risky? You don't diversify your market, or are you going to run out of properties in Phoenix to buy? And I kind of give people context. I say, well, in Phoenix, there's over 400,000 multifamily units right now. Okay. We own about 1% of those. 40% of the 400,000 is 1980s product, which is our bread and butter, focused primarily on 1980s value add. That's because in the 80s, there was a Ronald Reagan tax incentive plan, which incentivized builders to build apartments to get tax credits. And they just went crazy building apartments. So there actually is a lot of inventory here that has not been, picked over, so to speak. We can keep executing our business plan. And then I tell investors that, these properties, workforce housing, these are clean, safe communities. We may not live in them by choice, but if we had to, we would. And it's where the bulk of the demographic lives, and they're affordable. And so even in like the 2008, 2009 recession, when everybody loses their single family homes and they can't afford luxury Class A apartments, they all trickle down to this type of housing. Okay. So it's very insulated and very resilient in downturns, because the only type of housing below this is like ghetto D-class apartments with crime or mobile home parks, right? And so you're very well insulated in a downturn. And then, when you look at like the actual overall return or upside, by buying a B-class value add multifamily, you have a lot more margin to push your rents, push your revenue, and push your return, as opposed to if you buy, a new build Class A, because those rents are already tapped, they're already maxed out. There's not a lot of rent you can push to add more value. And so, we tell people, these aren't the sexiest assets that we're buying. They're not going to look as nice as a Class A, but they're more insulated and conservative, and you've got more upside for a stronger overall return as compared to other types of classes.
That's awesome. So share with us your investor profile. I know your background in the hospice. I mean, I would assume that majority of your investors are physicians. Is that correct?
Yeah, honestly, now it's not necessarily the case. They're all spectrums you can imagine. I mean, we've had now over 2,000 different individuals invest with us. Many of them are repeat investors. We're getting several first-time investors with us in every single deal. You know, I'm having at least 10, 20 plus new investors that we talk to every week. But yeah, initially kind of leaned on, you know, the physicians, healthcare business owners, but now, you know, it's primarily high W-2 income earners, you know, physicians, engineers, IT consultants, software salespeople, you know, executives, VPs at different companies. And then, you know, business owners, real estate professionals who are trying to take advantage of tax benefits. And then, you know, we do primarily 506B offerings, okay? Meaning that we can take up to 35 non-accredited investors, and we have to have pre-existing relationships. So we don't market our deals. They're not available to the public. And there's a couple of reasons we do that. We have done 506C, and I mean, now you're saying the bulk of sponsors, I think, are doing 506C. A couple of reasons we do the 506B is because, you know, one is that we did, when we did the C, we had most of our investors are accredited anyways, right? But a lot of them did not want to have to do the third-party verification of their accreditation. So we had a lot of our repeat investors not invest because they didn't want to have to deal with the documentation. Okay. The second thing is that we did not get a lot of value personally from marketing the deals on public platforms. Because what we found is that if investors are going to invest 50, 100K or more, they typically have wanted to talk to one of the sponsors and establish that relationship, build trust. So we did not have a lot of people convert from LinkedIn, Facebook, Instagram that see this deal and are just going to give you 50K unless they've actually talked to you. And so the biggest thing too is that we've really built this, you know, this sense of scarcity and exclusivity, right? So like our deals are not available to the public. When we launch a deal to our database, we're typically fully subscribed in 1 to 2 days. Okay. And it's really created, and it's true. And it's created a lot of scarcity and exclusivity where investors know, hey, if I'm on their list, you know, I'm kind of in the club, so to speak. I can invest in this deal. The track record has been really strong. But if I don't commit quickly, it's going to fill up. And that's the truth, you know? And so it kind of works in your favor. And I never wanted to be that guy, you know, that creates the scarcity. But when you're raising capital, you have to, okay? Because otherwise you're not going to raise the money. You know what I mean? You have to show that you have demand, and you can only do it by actually having the demand. And it's hard to do that, right? You have to have track record and build that. But it kind of is like a, you know, snowball effect where, you know, the more demand you get, the more scarcity you create. And then you're going to have a rolling list of investors that did not get in the deal that are waiting for the next one. And now they're going to be one of the first people that commits on the next one. And so, I mean, that's what we've seen. But, you know, we have people from kind of all walks of life, as long as they're sophisticated and, you know, understand how these things work.
Awesome. And I know you used to run a local meetup group, sort of an investor group. And I know you're also in other groups, and then same thing with the event you spoke at. Have you found investor groups like that to be a good source of passive money?
Yeah, good question, Tim. Honestly, not really. So we started a meetup in Phoenix, and at first, you know, when I was trying to get into it, I couldn't find a quality meetup of people who are actually doing it and who are providing good quality content. And so I was like, you know what, I want to create a meetup to genuinely provide value for people who want to get into it. Because I felt like I wanted to really, you know, provide that value to other people who were trying to get into it because I knew how hard it was. So we started doing that. You know, the first 6 months was a lot of fun. Then it starts growing. It starts becoming time consuming logistically. We started having 100+ people show up, you know, in person. This was pre-COVID. And then I started realizing you're getting a lot of home flippers, wholesalers, and we weren't hardly getting any investors from it. All right. So here we are spending all this time and money because we had to front our own cash to get the conference room, the food, whatever it is, AV. And we're like, you know what am I doing? Like, this is not actually benefiting my business, and I'm not capturing the demographic I wanted to do. Okay. I wanted to capture. And it's one of the main reasons we never started a podcast. We thought about it, but I realized, you know what, if I can be a guest on other people's podcasts, then I'm probably reaching more listeners And basically the podcast is featuring our company. And so we have a lot of investors who reach out to us because of podcast appearances who want to invest. But I did not get a lot of value from our meetup, to be honest with you. And then I had joined a mentorship program in 2018 called Brad Sumrock out of Dallas. And I did not get any value out of that. I mean, I don't regret it because I met my two partners through there. So the whole premise is you spend $30K, I dropped $30K to join that program. You go to these conferences to meet people with pre-existing relationships and you can raise money. Well, bottom line is that most of the people there are focused on Texas deals. The coaches didn't really understand Phoenix. And so, I was like, so we left after a year. Okay. So I didn't get any value really from raising equity from that group, but I met my two partners there. And that was, that alone was worth it because I had to meet people who, were really serious. Right. And if you're going to drop 30K, you're probably serious about wanting to do this. Right. And then we haven't gone to a lot of conferences the last couple of years, Tim. I mean, that Charlotte conference I met you at was the first one we've gone to in a while, just because we were trying to stay laser focused on operations. But now that we have a lot of infrastructure built out and delegation with our staff, we're trying to make a point to get out there more. And I think what we've seen is that more so than even the in-person is important. But we think the digital marketing component is a lot more powerful. Right. And so, we sponsored that conference. I think we spent like 35 grand on a platinum sponsor for that conference. And even if we didn't show up to it, I felt like we got our value because of all the digital marketing, that Dan Hanford does. And so I knew a lot of eyeballs saw it and will reach out to go to our website. So, now that we have revenue and we're well capitalized, we can start investing in different things to build our brand and awareness, which is ultimately where you start really raising real money. I mean, you have to get to that point, but now we kind of have a brand where we're kind of hitting investors, accessing them through different, channels of mass communication. And that's where you start having a lot of people reach out to you instead of you having to go and, fly all around the country and meet people in person. But both are important and they can both be helpful.
Right. Oh, that's really, really good. So I know I was trying to tag you on Facebook. You know where to be found on Facebook. I
don't have a Facebook and I've never had an Instagram, believe it or not. I'm not a social media guy really. I like LinkedIn, but my wife runs my LinkedIn. So we have a company Instagram, a company Facebook, and yeah, I actually don't have an Instagram or a Facebook.
Yeah. So is LinkedIn your most active social platform?
Yeah. LinkedIn is definitely, and we get a lot of leads from LinkedIn. Honestly, we get a lot of qualified investors, and basically, like I said, we're putting out content. So like we might put out articles on the Phoenix market. We might put updates like before and after photos of our renovations. I'll go out to the properties and do a video. We actually just hired a full-time videographer who's one of our staff members now, who's going to be doing marketing. So I'm going to properties. I'm saying, hey, we bought this deal at this point, renovated X amount of units, increased the rents X. So we're doing, providing quality content, and with the whole goal of kind of piquing prospective investors' interest. And in every single post we have a calendar link to drive to that calendar link. And the calendar link has a few qualifying questions saying, I understand this is a call to talk about passive investing. I'm not here to solicit services, because I kept getting like a bunch of lenders and vendors reaching out to me. Now none of them do that, which is nice. And say, hey, how did I hear about you? And what are my investment goals, right? So like 3 questions. So then you start to see where are these leads coming from, and you can start to see, okay, is this person, really worth the time? Because initially I would take every single call, but then when you start to see, you can't, have some people take up your time if they're not serious about investing. So, now I would say 95% of the people setting up calls are serious people who are looking to be, interested in investing. And so that's kind of how we do that.
That's awesome. And then, so you take them from whatever sources from LinkedIn, and your number one call to action is to book a call with you. Is that correct?
Yep. Yeah. To book a call. So even if probably our biggest source of investor referrals now is referrals from other investors. So almost daily now, no exaggeration, I'm getting other investors doing an email intro to their colleague, friend, or family. Hey, Zach, I want to introduce you to so-and-so. I've had a great experience. I'm telling them about it. They'd like to learn more. Okay. So then I'll say, hey, so-and-so, thanks for the introduction. Great to meet you. I'd love to get on a call with you. Here's a link to the calendar, or let me know when a good time for you is, right? The calendar link is just easy, but you don't ever want to seem like arrogant or cocky, like, oh, you have to set up a call on my calendar. But you try to always be polite. It's just easier though if they do it that way, to be efficient. So yeah, I mean, whether it's a referral from another investor or it's LinkedIn, or even like when we do like Google ads now, we do Google ads. We have a link that will drive people to our website, and there's a link on the website where you can set up a call with either Vikram, Robert, or myself. You know what I mean? So all three of us are doing this, but everything is to set up these phone calls. If you're doing 506C, you don't have to necessarily do that, because you can market the deal and people can invest without ever having talked to you. And in our opinion, though, in my opinion, it is not an effective way to raise capital. And a lot of people have said, oh, Zach, you're spending way too much time talking to investors. You guys need to delegate. You need to hire an investor relations person. Well, guess what? The people that tell me that are not raising anywhere near the capital we're raising. And I know that for a fact, because we've worked with some of them. And so you cannot take shortcuts, is my opinion. And people might say, well, you can't scale that way. Well, we're raising a lot of money, but you have to invest in these guys, in these investors, in these men and women on the front end. So like, I'll have a 30 to 45 minute call, sometimes 60 minutes. I had a 60-minute call with a guy yesterday, and he's going to invest 50K. And that might seem like a lot of time, but guess what? When I usually will have that call, they invest, and I hardly ever hear from them again. And they'll invest over and over and over. Some of them will do 50K for 10 straight deals. Some of them will do, I had a guy do 200K for like 12 straight deals.
Wow.
Okay, invest over $2 million. So I had a 30-minute call, because on that call, I go through everything, everything to the company, answer all their questions, establish trust, establish credibility. And then once they invest, they're getting monthly email updates, they're getting monthly distributions, and we've never missed a distribution. And so they don't have more questions after that, because we have the same business plan, and it's just different types of properties, right? So, but it's the same criteria, and they understand. And so like, a lot of them are not even looking at the materials now for repeat investors. They say, oh, Rise has a deal, I'm investing. You know what I mean? So you have to invest that upfront time. And it takes time to kind of get your spiel down. If you haven't established your company, you might not have much to talk about, right? But you're going to have to talk about what your track record is. What is your experience? What is your criteria for what you're looking for? And so that all just takes time. But I think you just have to get started, right? Get that first deal or two, and you start to build that momentum.
Right. Okay. And then, so once they book a call with you, regardless if they commit to investing or not, you send them a digital newsletter? Do you just send them a physical newsletter or anything like that?
Good question, Tim. So we use HubSpot as our CRM, and we have like the highest level. I don't know what we're paying. I think we're paying like 20 or 30 grand a year, because it has a lot of functionality. There's cheaper options down there, but we really like HubSpot because HubSpot integrates with Calendly. So when somebody sets up a call, and HubSpot it's not only a CRM, but it's kind of like MailChimp, right? We used to use MailChimp. It's probably the most popular one, people know, sending. We like HubSpot better because MailChimp, a lot of them are bouncing back, and HubSpot actually hit box. When somebody sets up a call, then it automatically adds them to our newsletter list. We do a monthly newsletter, which we call it like June 2022 recap, because we found that, and sometimes we might overthink it, but we're looking at all these different analytics, and we feel like when it says newsletter, people don't want to read it because it sounds boring. So we call it a recap, right? Well, it automatically puts them on this list. So they're getting our monthly recap. And then if they've actually had a call with us, then, because sometimes they set up a call, but we can't get a hold of them, whatever, rarely. Then after we had a call, you just check a little box in HubSpot, which adds them to our substantive list, right? Because we've had a call, we've established that relationship. Now we can put them on our list for future investment opportunities, but they're not going to be on that list unless they've actually talked to us, or if they've been a referral from a previous investor, then we can put them on. Okay, that is compliant according to the SEC. And I'll give the disclaimer: I'm not an attorney, but you can consult your SEC attorney, and they've told us that's fine. And so basically, when they set up a call, they're on our newsletter. Then they go into our CRM. We have like a newsletter list, a substantive list, so we kind of know. And then any marketing emails we have, like just closed on a new deal or just sold a new deal, they're going to get all that stuff. Okay, so they're going to start seeing, all this different content from us. And then Cassidy, our marketing manager, she goes through my Calendly daily or sometimes weekly. After I've set up calls, she connects with these people on LinkedIn. Right. So she's going in there and trying to friend them on LinkedIn, because we want to make sure they start seeing our content, and then those feeds going forward. So we're just constantly kind of staying on their mind. And HubSpot, it also integrates with our like investor relations platform. We use something called Monday.com. which is really nice. You know, it automates everything. And so yeah, there's a lot of different things that our marketing team and investor relations team has built out to kind of be efficient with that stuff.
Very cool. And what
Yeah,
type of...
One thing too, Tim, I forgot to say. So we've created a company overview deck. And so after every call, I just quickly manually send them this deck. Okay. Because I want it to feel intimate, like I care. So I'll tell them at the end of the call, I say, hey, I'm going to send you a company overview deck, which goes to the history of our company, our structure, our staff. So I email that to them manually after every call, takes 2 seconds. And then that kind of goes to the history of the company. So that we do that as well after each call.
That's awesome. And what type of syndication software do you use?
Yeah. So you mean for like our investor portal?
Yeah.
Yeah. So right now we're using Update Capital. And we've done demo calls with all the big names, IMS, Juniper Square, Syndication Pro. We like Update Capital the best because of the customization. It has all the same functionalities, all those other companies. It's also cheaper than most of them. However, there's additional customization that we've been trying to add that Update Capital can't quite achieve, right? And they don't have the bandwidth. And so about 4 weeks ago, we actually hired 2 software engineers. We spent about $350K, and we're building out our own custom portal just for our own uses, just for our own company. So we're going to be working, it should be ready by around January. We're going to have our own, custom built investor portal, and use that just for our own operations. And I mean, if it goes well, I mean, this is not the plan. I mean, we might offer it to like third parties, but right now we're just trying to focus on, it needs to do what we need to do, what we need for our purpose.
And so I'm curious, I know you've been targeting retail investors primarily. Have you considered going after family offices, institutional money?
We have. Yeah, we have. So, I mean, we've talked to a bunch of these private equity groups. We've flirted with them. We've even signed term sheets and gone down that path. But each time, it's a pain in the butt, honestly. Okay. And I'm not saying this is the case for everybody, but when you bring in a JV equity partner, you effectively become like an employee to them. Okay. Just so everybody knows. So the difference is that when you syndicate, you have, everything's on you, right? Like there's a lot of pressure on you to raise the capital, but you're 100% autonomous, and you're going to make probably 2 to 3 times more compensation per deal by syndicating as opposed to doing a JV equity. The JV equity, they will significantly limit your fees. They will also limit your splits. Okay. And everyone's different, but they're pretty industry standard. And so we've talked to these groups. Our biggest concern is that we're going non-refundable day one for typically $1 million to $2 million, okay, of earnest money. That's how competitive this market is. So like, it's our own personal cash. Like I sign a contract, wire $1 million to escrow, and we release it to the seller. It's non-refundable. It's gone. If we don't close, we lose it, right? So we have all the risk up front with the earnest money. And I know a bunch of groups where it happens all the time, where these JV equity groups, they don't give a crap about the sponsor. They could back out for any reason. They could back out the day before closing and not fund. So you're counting on them to fund that money, and that's your equity. They're typically bringing 90 to 95% of the equity is what is typically how the split is. And so we've signed term sheets, and then these guys are flaky. Like we've had a couple deals where we build out a timeline internally. We say, okay, we're going to go out to these 10 or 12 different equity groups. Because a lot of these guys are reaching out to us, right? The last 18 months, they're saying, hey, we're watching you guys. We want to do JV. We've got a bunch of capital to deploy. We love what you're doing. We get an intro call, a Zoom call. We send them all the materials on our company. They do a due diligence on us. And they say, let us know when you have a deal. We have a deal, and then we send it to them, and then they always shoot it down. You know what I mean? It makes no sense. We did a couple of deals where we set an internal timeline where we said, okay, we're gonna go and try to do a JV equity. And if by the end of week 3, they have not signed a term sheet with us, and sent us a draft JV operating agreement, we are pulling the plug and we're going to syndicate it. And sure enough, they drag their feet, and we say, screw this, we're going to syndicate this deal because we don't want to lose our earnest money. And so, a lot of people say, if you want to truly scale, then you have to go JV equity, okay, which could be true, right? But we disagree because we have 100% autonomy of our equity and the deal. Okay, so because of our track record, if we say a deal is a good deal and we send it to our investors, we raise the money, we close, we buy the deal. When we send these deals to other groups, the JV equity groups, I don't know what these guys are thinking. A lot of them don't have a pulse on a specific market, and they say, oh no, this doesn't meet our criteria, blah, 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 whatever it is. We've hit home runs, on a bunch of these deals that they've said were not good deals. And so we haven't gone that route. I think, our goal is to try to have a hybrid model where we're syndicating deals, and we do have some JV equity partners so we can scale, but we're not going to do it on a new acquisition. Part of our plan, actually, beginning of this year, we said third quarter, and now that's not going to happen because of interest rates, but we were going to plan to do a recapitalization with like 1 or 2 deals, right? Where we take an existing asset we own, we've renovated about 30 to 40%, drastically increased the value so that we can hit our target return for our LPs. And we would do what's called a recap or a recapitalization, where you basically bring in the new equity, right? So you basically cash out your retail investors, you can 1031 exchange them into a new deal. They hit their 1.8 to 2x multiple in like 15 months. So it's a home run for them. They have the option to 1031 exchange to a new deal. And then we as a sponsor retain the asset, bring in the new JV equity, right? And then we continue the business plan because we only renovated 30 to 40%. There's still meat on the bone. So the JV equity can get their yield by executing the rest of the plan. That's how we're going to do it when we do it. Because that way we're not under the gun of a new escrow and have the risk of losing earnest money. And so if they, try to screw us or fall out, whatever, then it's no big deal, right? Because we already own the asset. We had nothing to lose. So that is a goal of ours. We just haven't made a big emphasis on it because as we kept doing syndication after syndication, we saw our momentum growing and executing these deals. And so we're like, you know what? We're very fortunate and grateful to be able to syndicate these deals. And it's more fun, when, we're signing on the loan, it's our money at risk. We have 100% control because you feel like a real entrepreneur. I don't want to be, kind of working for somebody else. Some of these JV equity groups, they want to approve the color of the paint on the exterior. They want to approve leases. We've even heard from some groups. Wow. They want to like review leases that you're signing. So it's a different game. And so, but you can scale that way. You just have to understand that it's a different model.
Right. Wow. Now your funds, you said you have 3 funds now. Is that correct?
We have 2. Yeah, we have 2. We have Rise Fund,
okay.
Rise Fund 2. Yeah, we're going to start the 3rd one.
So what's your plan with your funds, since you're saying that your syndications are doing better or easier than your funds? What's your plans or your goals with your funds?
Yeah, good question. Bikram and I actually were just talking about this last night. And so we started the first fund near like around 3rd quarter of 2020 because deal flow was slowing, right? And we started having investors reaching out to us. And my whole thing was like, you know what? I have investors who are interested, ready to deploy capital, but I don't have a deal. So how can we have a vehicle that we're always raising capital? All right. That was the fund. That's why we started the first fund, is so that when we have investors who are interested, we can be taking their commitment and kind of secure that capital to deploy later on. Well, then end of 2020, and we did start that fund. And then 2021, we just kind of started going crazy with momentum, and we had no shortage of deals. We had like our pipeline built out for months into launching a deal every few weeks, filling it up, close it, launch the next one. And so we haven't really focused on marketing it, but I think now that we've kind of established more of a brand, right, and we have more of like a public credibility perception, I think that we could raise more money through the fund. And so I think one of our goals going forward is to make the fund 506C so that we can market the fund, okay, and only take accredited. That way we can always be raising capital for the fund, and it's not deal specific, right? That way we can capture, because we understand that, the way we're doing it now has been effective, but there's got to be a lot of people out there who don't want to set up a call or don't have time, right? Or they're nervous, they're shy, they don't like to get on calls. Some people are like that, but they have money to invest, they're accredited. And so, I think that when we first did our 506Cs, we didn't have the brand that we have now. So we want to still retain the 506B deal syndication and keep that exclusivity, but we also want to have this fund that we can really start to market and kind of always be raising capital from the public, so to speak. And so, that'll be part of the goal. And the way we do it now, kind of give everybody an idea, is that the fund is investing about 5% of the total equity in every deal. Okay, so Rise Fund 1 was every deal we bought in 2021, which was 16 deals, 2,800 units. So if you invested in Rise Fund 1, your money's diversified across 16 different deals. Rise Fund 2 is all the deals we bought in 2022, which is so far is 12 deals. It'll be 13 here shortly. And so the fund is just an LLC, and it's deploying about 5% of the total equity needed for each deal. And so basically, if you're in the fund, you're in all the deals we're syndicating. Most investors, from our experience, and this could be the way that we're just, trying to target investors. They wanted to invest in an individual deal because they see the economics and the specific business plan for that one deal. But what we think that we're trying to target maybe higher net worth investors who are, more of like the $500K $1 million investors who may want to be in the fund, because the fund is going to produce higher immediate cash flow out of the gates than investing in an individual deal. Your money is diversified across several deals, but your money's not going to be liquid for a longer amount of time. It could be 5 to 7 years until your money is liquid, because we have to sell all the deals in the fund in order to liquidate your investment, right? And your return will be the average return of all those deals. Whereas on the individual deal basis, we've sold 10 deals. Our average investment period has been 18 months. So we're basically flipping these things if we can hit a certain threshold of return, and then we 1031 exchange it. So it's going to be for like a different demographic of investor. But our goal is really kind of working towards possibly going public. And the only way to do that is to raise large funds, right? You can only scale syndication for so long. And, we're grateful to have that platform, and we're going to continue to do that and serve those investors. That's our bread and butter. But we do want to start to think about how can we, kind of attract other types of equity sources.
That's awesome. So talking about other sources of equity, with your background in sports, have you considered targeting the athletes? I mean, would those be your $500,000 $1 million per investment group?
Yeah, good question. I mean, we have not made, like a targeted movement to look at athletes. I mean, we have like a professional NBA player who's invested a lot of money with us. And we've had a handful of like pro athletes, no real big names, but I mean, it could be an option. I mean, we do have a decent amount of guys now that are doing 500 to $1 million, but most of them are like business owners, higher net worth business owners or real estate professionals. And so, we haven't really targeted that demographic, but and I don't even know honestly how to get to that demographic. What we were thinking, the fund is, if we're gonna seriously scale the fund model, then we probably would want to focus on kind of what Blackstone started out doing. And that's when they were targeting like endowments, hedge funds, pension, like teachers, firefighters, pension funds, things like that, different universities. And so that's why we want to start to build a track record of being able to establish a fund and raise capital. Because once you have track record for a fund, you can go to bigger sources, and start raising big money. Okay. And the compensation will be lower because you're going to have, one LP investor investing $100 million. But you can start to really scale at that point. And so our goal with pushing the fund now is going to be to establish track record so that we can start attracting, bigger groups. And these groups, when I'm talking about, are different than like private equity groups. Private equity groups, like I was talking about, they all have special member rights. They can really bend you over. You have no control. We're talking about true LPs, with like pension funds, things like that, but they're big checks. We just need to be able to establish credibility to attract those types of equity sources.
That's awesome. All right. So if you can do it all over again, is there anything that you would do differently?
Yeah. Honestly, I think I would start going to like conferences and like multifamily specific events sooner, because I spent 6 months trying to like cold call people and meet with people. And I felt like I was selling them on how this worked and trying to educate them. Then I started going to these conferences and everybody already knew how it worked. It was like before I was speaking a foreign language. And then it's like when I started going to these conferences, and I had just self-taught myself a lot of this stuff, right? It's not rocket science. Like everybody on this call, you can all teach yourself the fundamentals of this stuff through books and podcasts, et cetera. But if it's like, you don't know what you don't know. So when I started exposing myself to other people who were focused on multifamily syndication and understood it, then I think it collapsed the time frame, right? So I think that's the biggest thing is like, I think a lot of people, and I was guilty of this too, is like, it's scary and it seems so big and it's just really scary, but you have to think, how can I collapse the time frame? You don't need to wait. You just need to attack, right? And it's kind of, it's like the chicken and the egg, because you don't have experience, so you do a deal, you can't find a deal, so you can't get the experience, but you have to constantly be attacking. you still have to understand and be patient. It will take time, but you can't start to, let off. You have to keep attacking and saying, what am I going to do to push forward with the goal? And just know that you may not have tangible evidence for the first several months, but as long as you're continuing to focus on it and push forward, you are making that progress, even if it's like subconscious, right? And you're gaining that experience. So that's kind of what I would do, is just kind of jump into it and try to meet people quicker and identify what is the goal, attack that goal.
That's awesome. And we're going to wrap up this interview section here, Zach. And any last word of wisdom you want to leave with the audience here?
Yeah, I mean, the only thing I would say is like I said earlier, like if you have a goal, and it sounds kind of cliche or cheesy, but it's true. Like, don't listen to anybody who says you cannot do it. Like, don't take crap from anybody, because most people are going to say you can't do it. And it's probably because they're intimidated that you're pursuing a goal that seems so big that they would never even think to do. And even if you feel like you don't have the background or the qualifications, the more time you spend on it, you will have that qualification. So you just have to continue to attack and just start out with that first deal to get you the momentum, and don't listen to anybody who says you can't do it, especially if they haven't done it. Because my whole thing when I was going through this is like, I would get so discouraged by some people who I looked up to, who would tell me, you're doing the wrong thing, or, this is dumb. What are you doing? And then I started to realize it's like, you know what? You're not going to put in any of the work or go through the adversity that it takes for me to do this. So why would I listen to what you think? You know what I mean? It's like, I'm the one that has to put the work in. So I'm going to determine what the result will be. So I think that's what you have to do, is just don't listen to other people, and you will develop very thick skin through that process. And so I think that's what I would say.
That's awesome. All right, so we're going to open up for Q&A in just a little bit here. But before we do that, I want to just officially thank you so much, Zach, for being on this interview with me today, and the audience that we have on here. I mean, your story from where you started just, 3-ish years ago to where you are now, absolutely phenomenal. And yeah, this interview has been tremendously helpful. The wisdom that you share and all the knowledge and the experience that you share has been really great. So I really appreciate you.
Yeah, no, thanks so much, Tim. I appreciate everybody for taking the time to be on this and the opportunity. And I'm always happy to share anything, because I know how tough it can be. So appreciate you guys having me on here.